Welcome to today's deep dive. We're absolutely thrilled to have you with us today.
Yeah, really glad you're tuning in.
So today, our source material is this incredibly extensive, highly detailed Wikipedia article covering the Emergency Economic Stabilization Act of 2008.
Right.
But, you probably know it by its much more infamous title, the $700 billion bank bailout.
Yeah, it is. I mean, it's a piece of legislation that completely altered the trajectory of the modern global economy. No exaggeration.
Not at all. And our mission today is to look, way beyond those initial shocking headlines from the time. We are going to explore exactly how the U.S. government orchestrated one of the largest financial interventions in human history. We'll get into the fierce, really bitter battle over its design and the massive unintended consequences that followed.
It is fundamentally a story about what happens when the people in charge are told that the financial world is quite literally ending tomorrow.
Right. Now, before we jump into the deep end here, we need to make a really important note for you, our listener.
Yes, definitely.
The source material we are covering today contains some highly politically charged reactions from both left-wing and right-wing figures. So we want to make it unequivocally clear from the jump that we are not taking any sides here.
Right, absolutely not.
We're not endorsing any of the viewpoints or policies or, political reactions presented in this text. We are simply acting as your impartial guides.
Just reporting the facts.
Exactly. Reporting on the ideas, the quotes, and the historical facts exactly as they are contained in the provided material.
Yeah, our goal is understanding, not judgment. We're just here to look at the mechanics of history, really.
So, to really understand what happened, you have to think about how federal law is usually made. Usually there's this expectation of deliberate, almost tedious architecture.
Yeah, very slow.
Right. It's like building a skyscraper. You have blueprints, you have endless committee meetings, you measure twice, you cut once, and every single rivet gets inspected by like a dozen different people.
It's supposed to be a process defined by friction and, slow, careful consideration. We like to imagine our legislation is thoroughly stress-tested before it ever leaves the ground.
But then you look at times of absolute existential panic, and suddenly that careful construction process is completely abandoned.
Oh, out the window.
Right out the window. We aren't building a skyscraper anymore. We are desperately throwing sandbags at a bursting dam in the middle of a torrential flood, just, using whatever we can get our hands on.
Yeah.
And that brings us to September 2008. The global credit markets had essentially frozen solid, driven by this subprime mortgage crisis.
Yeah, and to understand the sheer scale of the panic, you really have to look at the dominoes that were falling at the time.
Yeah.
Lehman Brothers, an institution that had survived a century of wars and depressions.
Literally a century.
Yeah, and it essentially vanished overnight. And then you had the insurance giant AIG, which basically held the safety net for the rest of the entire financial system. And they were rapidly unraveling.
The level of sheer terror, it just cannot be overstated. On September 18th, the chairman of the Federal Reserve, Ben Bernanke, sat down in this dramatic meeting with congressional leaders, and he delivered a chilling warning. He reportedly told them, if we don't do this, we may not have an economy on Monday.
Just think about the gravity of that statement being delivered to lawmakers.
It's wild.
We may not have an economy on Monday. That is the precipice they were standing on.
And so the proposed solution came from Treasury Secretary Henry Paulson, who, it's always worth noting, was a former CEO of Goldman Sachs.
Right. That's a key detail.
He presented a proposal to Congress asking for $700 billion to buy up toxic mortgage-backed securities from these failing financial institutions.
Right. And before we talk about the bill itself, we should probably clarify what made those assets so toxic in the first place.
Yeah, good idea.
So a mortgage-backed security is essentially thousands of individual home loans bundled together into one giant financial product, which is then, sold to investors.
Right, but the real problem was what they were putting inside those bundles.
Precisely. During the housing boom, lenders started giving mortgages to people who couldn't realistically pay them back.
The subprime loans.
Exactly, the subprime loans. Wall Street took those bad loans, mixed them in with good loans, sliced them up, and sold them globally.
Wow.
So when the housing bubble burst and millions of people defaulted on their mortgages all at once, those bundled securities became incredibly toxic.
Because they were full of defaults.
Right. And worse, they became impossible to value because no one knew exactly how many bad loans were hiding inside any given bundle.
And we have to talk about the physical nature of Paulson's proposal to fix this. I mentioned earlier how deliberate federal law usually is, right? Thousands of pages, endless debate.
Oh, yeah.
Paulson's proposal was 3 pages long.
3 pages. To authorize the spending of $700 billion.
It's hard to wrap your head around.
It was intentionally short on details to facilitate quick passage, but the price tag wasn't even the most controversial part.
No.
It was Section 8 of the original draft. This section demanded unlimited power for the Secretary of the Treasury to spend this money, and it explicitly stated that these decisions could not be reviewed by any court of law or any administrative agency.
Okay, let's unpack this. This is essentially like handing a teenager a blank check for $1 million, letting them go to a casino, and legally banning yourself from ever checking their bank statement.
That's incredibly accurate.
Absolute immunity from congressional or judicial review. It's staggering.
What's fascinating here is the severe asymmetry of information involved in this proposed transaction. Investor George Soros strongly opposed this original plan, and he pointed out a classic economic problem.
Which was?
Well, because these complex, toxic securities were so incredibly hard to value, the Treasury was at a massive disadvantage.
Oh, I see.
Yeah, the sellers, the banks who originally created these bundled assets, they knew exactly how toxic they were.
So the banks have all the information, and the government is essentially flying blind.
Exactly. Soros argued that in any auction process set up like this, the Treasury would almost certainly overpay and end up with the absolute dregs of the market.
Yikes, the dregs.
Yeah. It was a catch-22. Unless the government vastly overpaid for these junk assets, the banks wouldn't get the financial relief they needed to survive. But if the government did overpay, the taxpayer was essentially being taken for a ride.
And as you can imagine, because Paulson's 3-page demand was so audacious and, completely lacked any oversight mechanism, it immediately triggered a massive visceral revolt.
Oh, yeah.
We are talking about a bipartisan uprising from both the general public and the academic world.
The reaction was swift and it was furious.
Protests literally erupted in over 100 cities across the United States. Just to give you a sense of the sheer volume of outrage here, Senator Dianne Feinstein's office received nearly 40,000 contacts.
Wow, 40,000.
Yeah, emails, calls, letters, overwhelmingly against the bailout. Senator Sherrod Brown reported getting 2,000 calls and emails in a single day, and he noted that roughly 95% of them were fiercely opposed to the plan.
It created incredibly strange political bedfellows, too. You had politicians from completely opposite ends of the political spectrum uniting against it.
Right, like who?
Well, liberal Senator Bernie Sanders and conservative Congressman Ron Paul, who, agree on almost nothing, were both highly vocal critics of this blank check.
And it wasn't just the public and the politicians reacting emotionally. The academic world sounded a very technical alarm.
Yes, they did.
Over 100 university economists signed an open letter to Congress warning of 3 fatal pitfalls in the plan. First, unfairness. It was a massive subsidy to investors at the taxpayers' expense. Second, ambiguity. The mission and the oversight of the entire program were completely unclear.
Because it was only 3 pages.
Exactly. And third, the damaging long-term effects of fundamentally weakening private capital markets, just to calm a short-term disruption.
Right. And the economists were particularly terrified of a concept called moral hazard.
Moral hazard. Right.
If we look at the core tenets of capitalism, the rule is simple. Investors who take massive risks to earn massive profits must also bear the catastrophic losses when those risks go bad.
Right.
That risk of failure is the disciplinary mechanism of the free market.
It's what stops banks from just gambling with our money every single day.
Exactly. And the economists saw that this fundamental rule was being completely abandoned just to prevent a short-term disaster.
Which naturally led to a scramble for alternatives. I mean, if not a $700 billion blank check to buy toxic trash, then what?
Right. There were other ideas.
Yeah, Senator Hillary Clinton suggested reviving something like the Homeowners Loan Corporation from the Great Depression era. This would basically be a program to help regular everyday people refinance their mortgages and freeze foreclosures.
Instead of just bailing out the top.
Right, rather than just funneling money directly to Wall Street.
And on the economic side, you had Nobel laureate Paul Krugman suggesting a completely different mechanism. Instead of buying up the bank's trash assets, which avoids that whole valuation nightmare Soros mentioned.
Right, the dregs.
Exactly. Krugman argued the government should just inject capital directly into the banks in exchange for equity, like preferred stock.
Okay.
Basically, the pitch was, if the taxpayer is saving you, the taxpayer owns a piece of you.
Wait, hold on. I have to push back on that a little bit. If the government is suddenly buying equity in private banks, aren't we just talking about nationalizing the banking sector?
Yeah.
Why was that considered a better option?
Well, that was exactly the fear of many lawmakers. But Krugman and others argued it was much cleaner. You don't have to figure out what a bundle of bad mortgages worth, which we establish is nearly impossible.
Right, you just look at the stock.
Exactly, you just look at the bank's stock price. More importantly, if the bank eventually recovers and becomes profitable again, the taxpayers actually share in that upside because they own the equity.
That makes sense.
Yeah. But under Paulson's plan, the overriding sentiment from the public was one of profound betrayal.
Right, because we had a scenario where the people who set the financial house on fire were not only being handed the fire extinguishers, but the taxpayers were paying a premium for their time.
Exactly.
No wonder the public was furious.
Yeah.
And this massive public and academic pressure actually worked, at least initially.
Briefly, yeah.
On September 29th, the House of Representatives held a vote on the legislation, and it failed.
It's failed.
205 to 228. Congress actually listened to the phone calls and said no to the bailout.
But the financial market's reaction to that no was utterly catastrophic.
It was an absolute bloodbath.
Yeah.
The Dow Jones Industrial Average dropped 777 points in a single day. At the time, that was its largest single-day point drop in history, wiping out $1.2 trillion in market value in a matter of hours.
Just
Gone. Oil saw its second largest one-day drop ever.
But perhaps the most terrifying metric to economists wasn't even the stock market. It was something called the TED spread.
Okay, for someone who, doesn't work on Wall Street, what exactly is the TED spread and why did it matter so much?
So the TED spread is essentially a measure of trust in the banking system.
Okay.
It's the difference between the interest rate banks charge each other for a short-term loan and the risk-free rate the Treasury charges.
Got it.
Normally, banks lend money to each other all the time just to balance their books at the end of the day. It's routine.
Right.
But after the bailout vote failed, the TED spread hit a 26-year high of 3.58%.
Meaning what, practically speaking?
Imagine your friend asks to borrow $20, but you know they just lost their job, their house is in foreclosure, and they owe money to 5 other people.
I am definitely not lending them the $20.
Exactly. You aren't going to lend them anything.
Right.
That is what happened on a global multi-billion-dollar scale. Banks were so terrified that their fellow banks were hiding toxic assets and were about to collapse that they simply stopped lending to each other entirely.
Wow.
The day-to-day financial plumbing of the world completely choked.
And that sheer numerical panic forced the Senate's hand. 2 days later, on October 1st, they passed a heavily revised version of the bill.
They had to do something.
Right. But here's where it gets really interesting. That original arrogant 3-page bill, it magically ballooned into 451 pages.
Yeah, quite the leap from 3 pages.
Why? Because the Senate added $150 billion in legislative sweeteners to bribe hesitant lawmakers into voting yes.
It was a masterclass in legislative brute force.
It's basically like a hostage negotiation. So to get Congress to swallow this bitter medicine, the Senate essentially took the broccoli of the bailout and buried it under $150 billion worth of legislative ice cream.
That's a great way to put it.
Tax extenders and pork, just to get the votes. We are talking about tax provisions, renewable energy credits, and alternative minimum tax relief. And it worked.
Yep.
The House passed the revised bill on October 3rd, and President Bush signed it into law within hours.
If we connect this to the bigger picture, this sequence of events perfectly illustrates the raw reality of crisis governance. There is a revealing memory from former Senator Evan Bayh about this exact moment.
Oh, yeah?
Yeah. He described the scene where Ben Bernanke warned them the sky was falling. Bayh recalled that they just looked at each other and said, "What do we need to do to pass this?"
Wow.
It wasn't about debating perfect economic policy anymore. It was about doing whatever it took to stop the bleeding, even if it meant attaching $150 billion of completely unrelated tax extenders to a rescue package.
So, the bloated 451-page Emergency Economic Stabilization Act is signed into law. Now we have to look at the fine print.
Let's get into it.
What did those 451 pages actually do to the financial system? Because the reality of how this money was used differed wildly from that original 3-page sales pitch.
Right. First and foremost, treasuries didn't get their blank check. The $700 billion was released in cautious tranches or installments.
Okay, so it wasn't all at once.
Exactly. $250 billion initially, then $100 billion, and a final $350 billion that was actually subject to a congressional veto.
They also added some much-needed oversight, completely reversing Paulson's demand for absolute immunity. They established a congressional oversight panel, a special inspector general, and explicitly made the Treasury's actions subject to judicial review.
And to stop regular people from pulling their money out of their local checking accounts in a panic, they also bumped up FDIC insurance.
Right. That's the amount of your bank deposits guaranteed by the government.
Exactly. They bumped that up from $100,000 to $250,000.
But then we get to the restrictions on the banks themselves, specifically regarding executive pay.
Oh, this is a big one.
Yeah. Limits were introduced for the top 5 executives of participating firms, supposedly preventing incentives that encourage unnecessary and excessive risks.
Supposedly?
Right, but these limits were full of massive loopholes. There were no hard salary caps whatsoever. And most glaringly, existing golden parachutes, those massive multi-million-dollar severance packages executives get, even if they run their company into the ground, those were left completely untouched.
Which brings us to perhaps the most bizarre, unintended consequence of the entire law. Section 128.
Oh man, this part is truly mind-boggling. Walk us through it.
Okay, so Section 128 allowed the Federal Reserve to begin paying banks a high interest rate on the deposit reserves they held at the Fed.
Okay.
Now, let's remember the stated goal of the whole bailout. It was to unfreeze the credit markets, right?
Right.
To get banks lending to businesses, to families, to get the economy moving again.
That was the entire justification for the $700 billion.
But because of Section 128, instead of lending that money out to Main Street, where there is always an inherent risk that a borrower might default, banks realized they could just hoard their cash at the Federal Reserve and earn a risk-free interest paid by the government.
That is just wild.
The numbers are staggering. Bank deposits at the Fed jumped from roughly $10 billion at the end of August 2008 to $880 billion by January 2009.
I have to stop and ask, if the entire stated purpose of this multi-billion-dollar rescue was to unfreeze the credit markets and get banks lending to everyday businesses again, why on earth did Section 128 literally pay banks to sit on their cash?
This raises an important question about the massive gap between legislative intent and structural execution.
Seriously.
The New York Times actually reviewed investor presentations from dozens of banks shortly after the bailout.
What did they find?
They found that very few banks cited lending to the public as a priority.
Of course not.
Instead, an overwhelming majority viewed the bailout money as a no-strings-attached windfall that they used to pay down their own debt, acquire other struggling businesses, or just invest for their own future.
So they essentially used taxpayer rescue money to buy up their competitors and consolidate their own power.
Exactly. Now, to be fair to the raw accounting, the Troubled Asset Relief Program, or TARP as it was called, it ultimately recovered its money.
Oh, it did?
Yeah. Out of $426.4 billion invested, the government recovered $441.7 billion, which is a nominal profit of $15.3 billion.
Okay, so they made a profit.
Well, though, when you adjust that for inflation over time, that might actually represent a loss. But, strictly speaking, the dollars came back.
But at what cost to the original promise made to the public?
That is the ultimate crux of it. The intervention absolutely succeeded in saving the institutions. It stopped the global economy from collapsing on that fateful Monday.
Right.
But it failed in its secondary promise of forcing those saved institutions to act in the public's best economic interest.
Yeah.
It was a massive structural flaw. The government successfully saved the banks, but they couldn't find a way to force the banks to save Main Street.
So what does this all mean? For you listening right now, understanding the 2008 bailout isn't just a dry history lesson about mortgage-backed securities and congressional votes.
No, it's highly relevant today.
It is a vital, living blueprint for how modern governments behave in a moment of total blinding panic. The rules of finance, the boundaries of executive pay, the mechanisms of market stability that quietly govern your life today, they weren't carefully debated over years in a committee room.
Not at all.
They were forged in a weekend of sheer terror, heavily patched with loopholes, and wrapped in 451 pages of political compromise.
It reveals exactly what happens when the fear of doing nothing suddenly outweighs the fear of doing something deeply flawed.
And that leaves us with a final thought to ponder, something to explore on your own long after this deep dive ends. We just saw how a 3-page memo, driven by the fear of imminent collapse, successfully initiated the mobilization of $700 billion in a matter of days to save the financial sector. What does that say about our society's capacity to fund other massive systemic crises,
Yeah.
like crumbling healthcare infrastructure or the looming existential threat of climate change?
It's a really good point.
The money, the legislative force, the speed, it's all clearly there. But it makes you wonder what it would actually take for the political establishment to ever feel the exact same level of immediate, terrifying panic about anything other than the stock market.
It's ultimately a question of what we as a society define as a true emergency.
We started today talking about desperately patching a bursting dam in the middle of a flood. The Emergency Economic Stabilization Act definitely stopped the water. The dam held.
Yeah, it did.
But when the water finally receded, we were left looking at a structure that was permanently changed, patched together with blank checks and political favors, standing as a monument to the day the architects panicked. Thanks for taking this deep dive with us. We'll see you next time.